Hi, weekly video just about liquidity, the way that I look at it in the markets. I just thought I'd start from the top down with a quick explanation. I'm looking at the Dixie here, which is one of the big ideas or providers of ideas about where liquidity is going, how it's moving mechanically through the system. When I look at different tickers, I tend to look at how they're affected, from the base liquidity coming from the Dixie or the VIX or the index, then through to the industries and the tickers. The couple of indicators I'm looking at here is the top one, which is a time-lag liquidity indicator. It gives us a range where we've had quite tight liquidity in the green, and then how that spreads out over a period of time into the red here, which is loose liquidity. And obviously, when you've had a tight period of liquidity, it doesn't just disappear really quickly. People are holding positions, and those take a while to wash out. Bigger players tend to hold positions for a longer time because of views about changes, political changes, governmental changes, market changes. They will hold those for a period of time and accept quite a bit of volatility because they're hedging out another position. So here, if we look at the Dixie, it had this green period coming through in 22. It's then had some loose liquidity over the next couple of years going into 24. It's then risen. We had a bit of tight liquidity coming in here to the election, some tightening liquidity. We can see it here in the irregular liquidity. It looks loose the whole way through, but we can see this tightening bit of liquidity that's then taken quite a while to wash out to where we are now. And from about January, we've really started to see loose liquidity. Just to speed this up here, I'm just going to look at the 4 hours, and we can see that we've had this loose liquidity has, there was a couple of tightening sections here when people were trying to decide about what was happening in the market. But really what's happened is in about February, we've seen liquidity, or the tightness of the Dixie, the want of holding the Dixie has disappeared. And that has been very strange because it's disappeared during a market pullback. We can see here quite loose liquidity and the price action goes down. We've now had quite a tight period of liquidity with the markets trying to go up, and we've seen a lot of movement in the markets positioning like they wanted to go up, but I think they found out that there just isn't the support anymore to drive the markets up, and so we're getting into the position we are now. We'll just have a look where that liquidity might have gone. It's gone various places. These decisions are probably made on some of them on fleet to safety, and also just on decisions that politically affect things. The first place that we can see that money has gone to is, I'm going to look, it's best seen here in the day, is money's just been going to gold, and that's because of the change in people wondering what's happening with government in the United States and how that might affect the investment community. And you can see, looking at this now, we have just seen money going into gold for an extended period of time since the turbulence in Ukraine. We have just seen money leaving. We went through this long period where gold was really tied to interest rates, and it was sort of fought around here. And then as soon as we had the incursion into Russia, it bounced from Russia. It bounced around a while, and now it's just continued this flight to safety into gold. Gold holding its value and being much safer. The other value that people discuss might be Bitcoin and things like that. We're not seeing that as a safety risk. It's now seen as an implement, I think, of the American government. And I don't think, if it's going to be organised by the American government and the current bureaucracies that are being installed, that it's going to be seen as a safe place to leave money. Unfortunately, I think that however good the cryptography is, it's leaving it. But anyway, we can see these great big pushes every time the market thinks, it's like we thought here going into November, that maybe this new government coming in the United States might be better than we had worried, but the worry has come back, and then we've seen some tightening of liquidity, and we've seen price go again. And every time we see a bit of loosening, the tariffs might be all right, off we go again. That was the bounce that we've just seen. The money's thought, I'm going back into gold, and it's gone back into gold. The other places we can see most recently that it's gone is we can see, I'm using as a proxy here the Hong Kong, I've gone into the wrong one, the Hong Kong futures market. And I'll just quickly start by looking at in the day here. We can see that we've got quite a big pump here in July last year with changes to policies by the CCP, the Politburo, and has the markets taken those. And then we start to see from here, and it's probably best seen in this time-layered liquidity, we can see here that from the decision that Trump didn't want to affect his inflation too much and wasn't going to tariff China too hard, we've seen this great flight to money. And that flight to money is about the same as when we start to see the topping of the US markets. And that flight to safety has slowed down a little bit now as we're coming into the April 2nd tariff discussions. In the American markets, as far as where we're looking at the money in bonds and treasury, which has always been the safe haven for the world, even though it's had some difficult times. We can see here this is the 30-year. I'm looking at it over a period of time since the pandemic and since the over fiscal stimulation. We can just see its value has gone down and down because there's just been better money to have, and it's also pushed up the rates, trying to slow it down with the Fed now and inflation. And we can see that there's a little bit of bottoming here, but we can still see in the time-layered liquidity, even though we're starting to get some good surface liquidity here. The thinnest line is the longest, the oldest part of liquidity, and the thickest line here is the newest, or the surface liquidity. The surface liquidity has started to tighten, but not greatly, so we can see a great change. If I just go and I'll quickly look, I think the 4-hour gives us the best look. We can see that we've had this bottoming period recently, and we can just see that this time-layered liquidity here is starting to tighten up, but it is really bouncing around. And then recently, with a couple of the data points, we've seen a real tightening here, and we haven't yet seen the price discovery in it, because soon as we saw that tightening, we then saw some bad data points come out, or some tighter data points, some data points that suggested that the employment wasn't turning bad, and that some of inflation was starting to be controlled, or maybe controlled, but the orders in the market were still quite strong. And so there's a little bit of not knowing where to go in the market. If we look at the 10-year, if we look at the 10-year, I'll just start the 10-year in the 4-hour. We can see it's been relatively, you can just see here, it's relatively green. I know it's a difficult one to see, it's traded very heavily, but if we just look, the majority of the green is under the line, and the 10-year in the United States has had a good period. It's gone up about 3%, 2% over the start of this year. From there, let's just go and have a look at how the markets are looking. I just go to my preferred view of the VIX. I'm going to look at the VIX really to see the surface liquidity and how that is affected. Kem Carson always tells us, I'm using a CFD, so it's not exactly the same as a CBOE index price list, but he always suggests that once the VIX is above 30, it's a much safer bet than buying when it's below, once the VIX reaches 20, it's a much safer bet than buying below there. And that's because you only need a little addition of tightening liquidity, and off it goes again. Once fear is going is another way of looking at it. You don't need a lot to get people to run away and hide. And so what we can see is that we've had this heightened period. Let's just drop it into days. We can see that if we look at the green, we've had since January, we've just slowly had this building heightened period, and we can see how green it is. And every now and then it's bounced out, and you can really see that this really started to loosen off into the Thursday, the 20th of Feb, when we started to actually see some other problems. Well, I think that's what the narrative was, that they were handed out to various things to do with Nvidia, which is quite unlikely, because so much wealth in the United States has been built in the last year and a half on the back of semiconductors. Anyway, we can see it's starting to drop here. I'm just looking at the 4 hours again, not really surface liquidity. We can see it stayed tight, and then it's just loosened up, and we can see it's loosening up here around the 12th. We can see that very easily in the open interest, also in the VIX and where that was being traded in the VIX. I'll do a special VIX and trade video a little bit later, just so I keep this one short. And we can see it's gone through a period of what looks to be really quite loose, and all of a sudden it's jumped off. Well, if we actually go and have a look at what's happened in the surface liquidity, now that we're above that 20 area, that we don't actually need a lot. It's pulled back and pulled back. It's really been above that line, but we didn't need a lot to get it going because it was already up there. So we've had these couple of sort of reactive bounces to do with data and people trying to get the market going since the bottom in the 10th to the 13th of March. But then we can see we just need these builds here, and we can see it here in the irregular liquidity. The irregular liquidity is just spanning the differences between the lit market liquidity when the American US markets are open, that in the dark space here, and the Globex here in the grey, which is the Australasian and European markets, and the black again being the lit markets. And you can just see that it's just slowly tightened up. It's sat around looking around thinking something was going to happen Thursday. We might see, a bit of a change. It loosened up, but it didn't. And it's just gone hard. It went really hard into the close. People thought the VIX was going to pull back. It was quite obvious that the VIX is going to win a battle when it comes to fighting with the indexes once it's at 20. So if we go and have a look at those indexes, here the first one I'm looking at is the NAS. I'm going to have a quick look at it in the 12-hour. Yeah, do I just hunt around for something that looks good to tell my story, to tell a narrative? No, all of these things work differently. There's different liquidities and the different way they are affected. You might have a ticker that looks like it's very tight liquidity and looking to go north, but because it's affected by indexes and by the industry it's in and decisions that go around that, even though it's very healthy and people are trying to, are keen for it to go up and they're making positions in it. So it's tightening and looking really good. The index comes across the top and knocks it on the head. So we can see here this is looking at the daily liquidity, and we thought right in there till Thursday the 20th when we saw that VIX rise, right in there till then it was going well, and then we can just see here that it's just stayed high, and then again it's some of that is washing through and staying till now. It's stayed in this period, but really it didn't get particularly tight. And then we've just seen it loosen off here about Thursday, the 13th of March, when there seemed like there was going to be a change in the market for a while, and at least a 0.5 retracement. But we haven't seen that. It was quite a short, not very steeply raising flag, and it definitely didn't have the power to get the bounce. Now my idea is that that's blaming it on the Dixie. There's just not enough power in the market to push itself up at the moment because so much money is leaving into these other markets that we looked at. The one that we didn't look at, we did look at the Hong Kong market. We didn't look at the European market. We'll have a quick look at that once we've just run through these. So if we see there that's what the deeper liquidity has been doing on the 12 hours. If we come into the sort of the closer liquidity, not quite the surface, not where you'd trade, but possibly where you'd make decisions on investing. And you can see here by about Tuesday, it was telling you that it was coming out. You can see this is raising. It's a little bit indecisive, but it's up in the top half. It is really loosening after having this quite tight section and a really good bump. It's been sold at this top here Tuesday, Wednesday of this week, and it's just loosened right up. And we can see on the surface here it's just loose and going sideways. SPY, fairly similar. And look, I do look at different bits of the liquidity in time, and that's got a lot to do with the makeup of liquidity. Liquidity is our indicator requires a good price action and a reasonable volume, and you don't find that in all indexes, and you might find it in a CFD product. And what you're trying to do is find that very good, strong causation happening over a period of time, so you can see that the volume and the price action is being represented, and so that you'll get a causal, not a reactionary liquidity. A lot of liquidity is just reactionary. You get a causal liquidity of a build. That we were looking at in the VIX. So we get a build of liquidity, and then we see the response afterwards. So we can see that the price action is then the price discovery comes out afterwards. So here we can see we had a really good dip. It really looked like it was going to tighten. This is in the SPY, but the SPY hasn't really been the one driving the market. The market hasn't been driven by the rest of the S&P 500. It has been driven by the NAS. So when we were looking at the NAS, we can just see that it's become looser and looser, even though the SPY was really good in this period. The NAS isn't. The NAS has really stayed loose, even with that pumping, and that is a lot to do with people are taking their money out of those Mag 7s. If we just go and have a look here, this is a different view of the SPX. This is the SPY. This is one of the ETFs, and it's telling you it's a lot clearer. It's showing you that the liquidity really had gone here by about Tuesday, and even here it's trying to bounce a bit, but it's fighting the VIX and it's not winning against the VIX. Last one I just wanted to go over while we were doing them. I'll go back and have a look in Europe in a second. Is here we're looking at Bitcoin, and Bitcoin's had an interesting period, but really over time, if we look at it, it's had this really strong, tight liquidity happening here coming into the election victory to the new Trump government, and then since it's got in there and it started to realize that action wasn't going to be great with liquidity, Bitcoin is a really great place to look at the overall market liquidity, and it's been fighting it. If we go in a little bit closer and we see what it's been doing closer, maybe we're in the 2 hours, we can just see here that it keeps on getting, it gets a really good tight, just trying to push through what all of the technical traders see here as a resistance line, but there just isn't enough liquidity to push through it. So even though we get these sections coming up, this was 24th of Jan, this is the 20th of February, these were crucial times when we were trying to push through these barriers, and we thought the market would break out and we positioned ourselves for them. But at the end of the day, we can just see that there is not the wind left in the sail of the US liquidity into these different instruments. So here we can just see that during this week, it's just really liquidity has dropped off and got us into this area now where we are, and it's really just been sitting up high. I suppose you can see the surface here is saying it's sitting low and green. Well, I think that's reactive as it's been dropping. If we look at this chart of irregular liquidity rather than this time lag, which is affected by the Globex time of whether it's a lit or a dark market, we can see it's really been sitting quite high, apart from this one big dip that we've seen and maybe this more recent one, and both of those I think are reactive liquidity. This one might be a little bit causal. There's been a little bit of trading when people have got up on Saturday morning to see whether there was a dip to buy in America, but there hasn't been a dip to buy. All right, thanks for listening to my weekly liquidity update. I'll try and make them shorter and faster. Now you understand a little bit more about what I'm looking for when deciding where the markets are. So I think the markets are quite loose this week, apart from the VIX. The VIX is very tight, and I think that we're going to see more down action than up action this week, whatever happens with the August 2nd PMIs before then the August 2nd tariff deadline. Thank you very much.